Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I sit down with Professor Partha Mohanram, Professor of Accounting in the John H. Watson Chair in Value Investing at the University of Toronto. Professor Mohanram's expertise and research spans across different areas of finance, but our conversation mostly focuses on his work that sits at the intersection of accounting, finance, and the potential drivers of stock returns. The professor's most downloaded paper, the one based on his G-score method, is one of the models we've captured quantitatively on Validea. The professor's depth of investing knowledge, along with his ability to easily explain concepts, is impressive and refreshing. Thank you for listening. We hope you enjoy the discussion. Oh, just one other thing. If you find this episode valuable, and if you write a review on Apple Podcasts and email us a screenshot, we'll give you 1 month free of Validea Professional. This is a $100 value and is our highest end research product, and one that includes access to the top performing model based on the G-score method and Mohanram's research. Professor Mohanram, how are you? Thank you for joining us today.
Oh, I'm very well. Thanks for having me.
I don't know if you remember this, but we actually met with you when you were at Columbia in 2006.
Oh, I remember it very clearly. I remember I probably looked 15 years younger. It was almost 15 years ago. And, I was a totally unknown junior assistant professor at Columbia. I'm still relatively unknown senior tenured professor now at the University of Toronto, but very little has changed. So I remember meeting you guys very well. And I actually had lost track of you guys and your company till a few years ago when I guess some person who was looking at your website sent me an email or a text saying, hey, Partha, you're listed as a guru on this website, along with like some pretty big names. And so I went and checked out your website, and like I remember I posted it on Facebook, and me and my friends had a good laugh about it. So I do remember that very well actually. So yeah.
Yeah, well, I think you're right. It's like 15 years ago, we were obviously a lot younger, and I'd like to think we've become a little bit smarter with the markets, but sometimes with time, you realize that you clearly have a lot more to learn and always learning. And that's the one thing that, yesterday I printed out your CV because I wanted to just kind of bring myself up to speed. And Jack and I have been talking about, what we were going to ask you. And it was funny. So I downloaded the CV, and then usually when you print out a CV, it's like 1 or 2 pages. So yours was 11 pages long. So you clearly have a lot of stuff and interesting stuff that we want to talk about with you. But I thought maybe you could, just to start and set the stage a little bit, if you could kind of give us an overview of generally where your research interests lie and maybe how they've evolved over the years a little bit. I mean, we're going to talk about a lot of different pieces of research as we get into this, but I think sort of a summary overview of your research would be good to start.
So thank you for those kind words. A disclaimer, right? Some of those 11 pages are like really boring stuff, like every place I've ever presented at and every course I've ever taught and stuff. So it's not nearly as impressive as 11 pages appears to be, but thank you nonetheless. So let me give you an overview of my research. In fact, let me go back even further in time, okay? So one thing you will notice is my research is sort of I would call this at the intersection of finance and accounting, right? So I'm actually in the accounting department, but accounting area, at first at NYU and then at Columbia and now at Toronto. But my research has always had a very strong capital market focus to it. And that goes back very from my PhD days, where my PhD was in business economics at Harvard. And this is a joint program between the econ department and the business schools. And even though my advisors and all were mostly from the accounting areas, the area I was always interested in was always sort of markets and, things like that. I started off actually looking at disclosure. So my thesis and my early research was on disclosure. But then when I moved to NYU, where I started my career, I started working on, it just so happened I started working on topics related to valuation. So my very first paper I ever published, and this really goes back in time, this was around the year 2000 when we're trying to understand what determines the valuation of internet stocks. And we started working on the paper actually before the crash happened, but obviously the paper was published after it happened. But what we kind of found in that paper was even in those incredibly irrational times, financial statement variables actually had predictive value. So even when you're talking about, let's look at the, I'm pulling out names from my hat here, okay? The valuation of drcoop.com was one of those brilliant companies which, rose like a shooting star and then crashed and burned, right? Even in those sort of incredibly irrational environments, fundamentals seem to matter. So I've always had this sort of interest in my academic career. So if you look at my research, right, there are 3 or 4 streams of research. One of them is very obviously this valuation, stock picking, so like, for example, this G-score and a couple of the papers that you guys are probably very familiar with. That's one area of research. Second area of research is I've done a lot of work on, some work on disclosure. That is how financial statements and how they are presented, how that information is actually used or misused by people, different people, whether it be intermediaries like analysts or just end users or whatever. So I've done a fair amount of research on that. I've also done a lot of research on this idea of cost of capital, specifically this idea of implied cost of capital, which is trying to use the market and forecast to figure out what the implicit cost of capital must be in the market's terms and how that metric might also be a useful sort of proxy for people to look at. So those have been my 2 or 3 streams of research. In general, if I was to look at unifying theme, right, I look at things which require you to have insights in finance, accounting, and just sort of economics or business strategy. So the bottom line is people, and by people it could be investors, it could be intermediaries, it could be the firms themselves, take numbers as given without understanding what's behind those numbers. And that can lead to bad decisions. It can lead to bad decisions for investors. It can lead to bad decisions for boards if you're compensating CEOs on earnings and you don't pay attention to how those earnings have come into being. It can, so the bottom line is just pay attention to not just the numbers, but how those numbers got into the form that they were in. So that would be my sort of overarching summary of my research.
Great. That's a great overview, and I think mosaic of the things that you've spent your career really working on and investigating. You're right. We run the strategy based on the G-score model on Validea. I know you talked about this on the podcast with Tobias Carlisle. It is one of the better. We've been running it in real time since 2006, and it's on the long only side, it's one of the best performing strategies that we run out of, there's 22 public strategies now that we run and track. But I wanted to just ask you, and we're not going to spend too much time on this just because we've talked about it in other podcasts and you obviously discussed it at length with Toby, but just if you want to give sort of a high level overview of what that model is trying to uncover within the growth stock category. And also it just made me think of when you were talking about your initial research with those NASDAQ companies, did that play a part in the formation of this G-score idea and research? Because you were seeing that these companies, obviously the fundamentals weren't good, but yet they were really strong performers in the growth stock category for a period of time, but then they obviously fell apart. So did that early research play a role in your G-score development?
Well, Justin, I had never thought of that till you mentioned it right now. But you never know how these things work. So maybe implicitly in the back of your mind, it might have done something. It's very easy for you when you think back you look back at your Vita and you say, okay, this paper I wrote because of this, blah, blah, blah. There's a huge amount of serendipity in all of these things. You just sort of do something because somebody comes up and you see something and it kind of causes a light bulb to go off in your head and you say, hey, this might be interesting to look at. So I'll give you an anecdote. Actually, it's not related to G-score, about how I wrote a paper based on that. So I have a paper actually with a colleague of mine called Eli Bartov at NYU, where we look at options, okay, option exercises, and we look at unusually large option exercises, and we show that when CEOs have unusually large option exercises, we associate that with a period of earnings management before the option exercise. So we actually say that, these guys are potentially building up to having a really strong year. That year they exercise a whole bunch of options. And then, earnings management has a habit of reversing, right? If you're using accruals to build up your earnings, eventually those things will reverse. And then afterwards, the stock price might fall, but the CEO doesn't care because he or she has exercised their option. In fact, he might be getting the new options at a lower price if the stock price tanks. Actually motivated by my co-author coming up and telling me that I've been noticing that this guy, Mike Eisner at Disney, he exercises a lot of options, but he does it every X number of years. I wonder if this is systematic, if these guys are actually doing this. So that simple idea, in this case for my co-author, brought this thing to the fore, and we decided to test it. So very often things like this cause you to trigger research ideas. In my case, right, the idea for the G-score paper came very simply because I came across the F-score paper by Piotrowski. And Joe is somebody I actually know professionally, and I knew him personally as well. So I read the paper and I found it very interesting, and I said, this is a very interesting idea. And I also teach financial statement analysis, or some version or variant of that course, where we actually use these financial statement indicators and stuff. And so it seemed like a very practical, interesting idea, and it showed that there is value to doing this very, very basic things that you would think shouldn't predict value because everybody ought to be doing it. So the question I asked was, if this stuff works for value stocks, should it work for growth stocks? And that's how that idea sort of started percolating in my head. And my second idea was, why didn't Piotrowski try to use this for the universe of stocks? Why was he focusing only on value stocks? Is there something different about growth stocks which would cause you to kind of want to do something slightly different? So that was the genesis of the G-score paper. And if you look at the different signals within that paper, right, it also ties into this earlier point of mine that you shouldn't take numbers as given. So like, for example, the G-score paper focuses on high market to book stocks, or what we call low book to market stocks, right? But many of these firms, they have high market to books ratios, not because they're potentially overvalued, but because their book value is potentially understated. And why is the book value understated? It's because the accounting forces them to expense certain things, even though in reality these firms are creating assets and stuff. And those assets are never going to be, and assets in the corresponding, let's say, shareholders' equity or whatever, is never going to be on their actual balance sheet. So many of my signals required not just an understanding of what the firm is and what it's doing, but a pretty high level, at least a high level understanding of how accounting can potentially distort some of these ratios, and how understanding these ratios at slightly more, let's say, atomic level can help you make better decisions.
It's interesting because you just partially answered my next question, which is I was going to ask you about intangible assets, because I think one of the reasons your strategy has done very well is you are getting at a lot of firms that have very high levels of intangible assets. Sort of at that top of the price to book range, you have a lot of firms that have high intangibles. And then right, you're looking at things like R&D and advertising that, probably create those intangible assets. Exactly. And I'm wondering if all of us are missing something in terms of how we're accounting for all that. Do you think we need changes to the way we measure assets? Because, estimates are intangible assets might be something like 80% of total assets across all companies right now. Do you think we need to look at this differently? Or do you think standards might have to change in how we look at these intangible assets?
See, this is a very interesting debate. And I actually, there's an article of mine. No, it's not an article of mine. There's a debate between me and Baruch Lev, who's this very, very highly regarded professor at NYU. He's a big proponent of changing the accounting standards and mandating some sort of forced capitalization of these intangible assets and stuff, saying that his argument is accounting isn't measuring what it ought to measure. Okay, I actually disagree with that for the following reason, right? If you make it one size fits all, you are essentially, as it is, there are tremendous amounts of ways managers can manipulate accounting. You're just giving them another massive tool to do so. I think a better approach is let the accounting be where it is. Because whenever you are forcing this sort of, these assets by nature are speculative, right? You are essentially putting a speculative asset onto the balance sheet, and you're forcing auditors to sign off on the valuation of these very speculative assets. I think a better approach is to have the accounting stay as it is. And you can actually mandate footnote disclosure saying that firms should provide more information about the nature of their intangible activities. And then you and I, as investors, as users of financial information, we should feel free to make these adjustments as needed. So if you just think about the approach in G-Score, right? G-Score took the book to market or market to book ratio as given, but then it tried to account for the fact that book values can be understated by having signals associated with it. I personally think that's a better approach because it allows you to distinguish between two high market to book firms, one of which is actually spending lots of money on these intangible generating activities and one of which is not. So, I'll send Justin a link to that article where I actually have this discussion with Professor Lev. And I'm not saying he's wrong and I'm right. I'm just presenting two sides of the story. One of it says this thing should be in the balance sheet. Accounting is missing what it's missing, missing all these new economy intangible stuff. And the other view is, yes, we know that's the case. But do we want to give these assets the good housekeeping seal of approval and put them on the balance sheets? The answer is it's not very clear-cut.
Yeah, in many ways you were ahead of your time in this because this is a big thing now. A lot of people are looking at how do we enhance the price to book with intangible assets. And, you recognized back when you wrote this paper that you could sort of adjust this and with these tests, you could identify these types of firms. But you're probably right. I mean, it would be difficult you probably have all kinds of manipulation issues and things like that if you started putting this stuff onto the balance sheet.
Right.
I want to also ask you, go ahead. Sure, go ahead.
Sorry, actually, around that same time, a few years later, I think in 2007 or 8, I was actually working on a project with one of my former colleagues at Columbia where we tried to do sort of this enhanced book to market ratio, but we were thinking of it more in terms of, the pharma fringe factors. And pharma use like book to market as one of their factors, right? It's their HML or whatever, right? Which uses the book to market ratio. We wanted to see if this enhanced book to market ratio, which accounts for all this R&D and advertising and so on and so forth, that actually helps the performance of the pharma fringe factors. And the answer, if I remember right, and we didn't really pursue this further, was it does, but the magnitude of the differences are so small it wasn't worth pursuing. So okay. that's something we were working on like way back when, like more than 10 years ago. So.
Yeah, and it's also interesting at the sort of at the bottom of the price to book range, this has a lot less of an impact. So those types of firms have less intangible assets, whereas the top where you're dealing with the G-score, they have way more. Right. So the Piotrowski firms, which he looked at, it's not a big deal at all for him. So, but certainly for the sorry, I'm sorry, I'm moving a bit. Right. No problem.
The G-score sample, the intangible assets is really and how you account for it can make a big difference.
I wanted just one more question on this. I want to ask you about how we define value and growth. All of us, whether we're practitioners or academics, we tend to say, all right, value is your cheap stocks and growth is your expensive stocks. And one of the things I thought about testing with G-score, and I was just wondering what your thoughts are and if it would be valuable, is what if we tried to use a measure of actual growth, maybe as the starting point, and then apply G-score beyond that. So if we look at something like, say, fundamental momentum, like stocks where momentum is, fundamentals are improving, or something like price momentum, things that have been positive factors over time, do you think that would potentially enhance it? Or do you think maybe you're already filtering out the best firms from that expensive group, so there's probably no value to be added there?
I have to actually give this some thought. So you're saying don't use the market to book or the book to market ratio as your first card. Just look at growth itself.
I'm just saying, if you could argue maybe that there's some stocks that are expensive for a reason and maybe some that aren't. And so But then again, you're
So
getting at that already with your strategy. So maybe that wouldn't add any value because you're already trying to filter out the stocks that are expensive and deserve to be expensive.
Right. So if you, I saw the list of questions that Justin had sent me, and one of them was talking about my more recent paper, right? The one where we try to combine both quality and value or in as strategies, right? The thing about both G-score and F-score, as done by Joe and myself, we are looking only at fundamentals, right? We're not looking at valuation per se. We're saying, hey, here are some fundamentals, and here are some firms which rank very highly on fundamentals, and here are some firms which rank low on fundamentals. And if the market doesn't get it or has not been paying attention to it, this should predict future returns. But it doesn't take into account the fact the market might be taking into consideration. And so in my recent paper, which I published, I believe last year in Contemporary Accounting Research with Kevin Lee, we tried to use this valuation ratios, and we use two ratios. One is we use this ratio called the V2P ratio, where we estimate intrinsic value by looking at the forecast and stuff and saying, okay, this should be the value of the firm, and compare it to price. And we say a high V2P stock is one which appears to be relatively less valued, so it's undervalued. A low V2P is the other way around. And we try to interact this with the F-score and G-score. Now, as it turns out, F-score predicts returns, G-score predicts returns, and this V2P ratio also predicts returns. But the correlation between F-score and G-score and this VP is actually negative. That is, and this is a very, very old insight. I'm not the first one to say it. If you go back to Graham and Dodd, their strategy actually has both aspects to it. They're looking for stocks which have good fundamentals and stocks which appear to be relatively cheap, right? Because it turns out the average stock with good fundamentals is not cheap. And the average stock which is cheap doesn't have good fundamentals. Because on average, markets are sort of efficient. Like in the quality is kind of priced, right? But having said that, there will always be what I call off-diagonal elements. There will always be some high quality stocks which appear to be relatively modestly priced. And there will always, and the second is certainly true, there will always be some highly priced stocks which have poor fundamentals. So if you can identify those off-diagonal elements, it can be extremely valuable. So if you're a long-only investor, you want the moderately priced stock which has very good fundamentals. On the other hand, if you're somebody who likes to go long-short, you care about the other off-diagonal element as well, which is the highly priced stock which actually has low fundamentals, and so it doesn't deserve to be highly priced. So that's what my second paper kind of tried to get a handle on.
And that paper was the fundamental analysis combining the search for quality and the search for value. That's the title.
Exactly.
Yeah.
Exactly.
And were the long-term, that was, what'd you do back to like the 1970s on the back test? Do you recall?
No. We go all the way up to, we go all the way back to, I believe, the early 70s, but we go all the way up to 2015 or something. So
right. Yeah. It's a multi-decade, and the results, I believe, the combined value and quality performance is superior.
Yeah. It's of course, to be fair, we are looking at finer and finer subsets, right? So we're not comparing apples to apples. You're not comparing deciles to deciles. Mm-hmm. But having said that, we also show in our paper that this is much better than what you could do with just a finer cut on value or finer cut on like this thing. So for example, even if you look at the top 5% of this particular single dimensional strategy, this multi-dimensional intersection strategy we come up with does much better. So it's important to look at. So the point is, there's no point buying a high quality stock if it's fully priced. If the market knows its value and it's giving this firm a very, very high multiple, there's no alpha left there because the market's realized it. So what you want is you want those firms which certainly have high quality, but relative to their quality, the valuation still seems reasonable. That's the basic insight of that paper. So it's just an additional cut saying that don't do G-score by itself. if with the, or don't do F score by itself, if you can combine F score and G score with some dimension of value, and the word value here doesn't mean value versus growth. It's value with respect to what you should be worth. So you could have a quote unquote value firm, which defined using the book to market ratio, which is not really a value firm because it's really deserves its bad valuation. On the other hand, you could have a growth firm, which would still be a value simply because relative to its growth prospects, it actually is reasonably priced. So.
Yeah, this gets at the whole idea that Google really was a value stock, 5 years ago, considering what it's done
absolutely.
Since then.
Yeah, and you can argue that, like, I mean, I've been having, so I'm, by the way, I'm not somebody who invests that much in individual stocks, maybe to my detriment, because I had like a friend of mine who asked me to buy Tesla at $500, like, a few months ago, and I didn't. So, but when you watch a stock like Tesla going up, right? I mean, you have to wonder like what actually is going on. But on the other hand, you take a company like Google or you take a company like Apple or whatever. I mean, yes, the valuations are ridiculously high, but the fundamentals are ridiculously good. So the question is, can you just say that because a firm has a valuation of $2 trillion or whatever it is, that it's overvalued? The answer is not, because you got to look at the expectations of future cash flows or earnings and stuff and see if this stock seems reasonably priced relative to its fundamentals. And the answer might well be yes. So.
Playing on that whole thing with quality versus value that you talked about in your paper, one of the things all of us that implement these types of strategies sometimes struggle with is sort of the Warren Buffett versus the Ben Graham debate. So if you were to look at Piotrowski's work, that's more of a Ben Graham strategy. So he's starting with value, and then within that value, he's trying to find the highest quality companies he can. And your work is sort of the other direction. It's more the Warren Buffett way. I'm going to start with quality, I'm going to get high quality companies, and then I'm going to find the cheapest ones I can. And I'm wondering what you think about that. I mean, obviously you wrote the paper supporting the quality first approach, but I'm wondering, do you think there's a right way to do that? Or do you think it's sort of in the eye of the beholder in terms of how that's done? I'm just wondering how you think about blending quality and value together.
So in my most recent paper, like, we literally do them parallelly. Like we said, let's do quality here, let's do value here, and let's intersect the two.
Okay.
So we really don't even have a hierarchy that I do quality first and then look for value. I don't do value first and then look for quality. I literally intersect the two and say, I want quality that's reasonably priced. So, I mean, I'm going to repeat an analogy I used in my the Acquirers podcast interview, which is, I really like this analogy, this TJ Maxx School of Investing. It's like, you actually go, like, most people, when you go to a place like TJ Maxx, you're not going there to buy something specific. You're going to look for deals, but you want to look for something which is of high quality as well. So you go there and you can say, I scored this really nice Calvin Klein jacket for like $100. It would have cost me $350 normally. So I have the quality that it's a Calvin Klein, but I have this sort of pleasure that I paid $100 for it when its notional value could be $350, right? So what you want is, you want the quality which comes with all your fundamental signals that, this firm has earnings, it has earning growth, the accounting is actually pretty solid, all those kinds of things. But at the same time, the valuation ratios or whatever, like in my case, the V2P or whatever, gives you assurance that you got a deal as well. So if you can combine those two approaches towards your investing, at least that paper shows, in the long run, you'll do pretty well.
Yeah, it's sort of a best of both worlds approach.
By the way,
Exactly.
TJX and TJ Maxx is it's been a great stock.
Okay.
No, it has.
I hadn't even thought about the stock. I was thinking more about the company and its products. So.
Yeah. One of the things, and you've kind of answered this, I think it's weaved in, but I wanted just to ask you, obviously, like traditional value investing, low price to book stocks, if you're just doing a sort on that, it's been a pretty tough decade for portfolios that are built using those types of metrics. And, there's a lot of different arguments. I mean, some are saying that, technology has broken value investing, or the Federal Reserve policy with low interest rates. And to your point about these, large cap tech companies that have really grown in and delivered on their fundamentals. I mean, obviously they're making up more and more of a heavier weight in these market cap weighted indices. But do you ever think about this struggle of like what I would call like traditional value investing, and maybe have any thoughts about what it may mean or what it may mean for the future? I know it's a pretty broad question, but I'm just wondering what your opinion is on the struggles here.
See, I think the struggle has to do with the fact that this is like going back to your earlier question, and I think Jack's earlier question about what the definition of value is, right? If you take this incredibly static definition of value is defined by a valuation ratio, like the book to market ratio, the pre-P2E ratio. Yes, these stocks have gotten hammered, right? That's because people have been extremely mechanical, saying, I will not buy a stock whose PE ratio is like, more than 10. Or I will not buy a stock who's like, trading at like a market to book ratio more than 1.5. And so you start putting these artificial strictures on yourself, right? Without asking a question about why is your PE ratio more than 10? Or why is your market book ratio more than 1.5? So I think because people have been so mechanical about the definition of what value investing in is, they haven't really been doing value investing. They've been doing very mechanical investing, right? Value investing is value. So I keep giving my students an analogy, right? Like let's say you have two cars. Let's say you have a Hyundai and you have a Mercedes-Benz S-Class, right? The Hyundai might have a value of $25,000 and the S-Class might have a value of $100,000. But what determines the value of that particular asset is what it's trading at with respect to what its intrinsic value is. Suppose you're able to get that S-Class Mercedes-Benz for $80,000, right? And you're going to get the Hyundai at full price. That Mercedes-Benz S-Class just became a value stock. So technically you would consider it to be a luxury item. It's highly priced and so on and so forth. But relative to its intrinsic value, it's trading at a lower price and therefore it's a good deal. So if you take a similar kind of approach and say, don't use mechanical multiples. So in this, if you use a mechanical multiple like the price to earnings ratio or a price to book ratio, you wouldn't have considered buying that Mercedes-Benz S stock. You would have not considered buying a Google or a Microsoft saying, oh, no, Google is kind of expensive. Apple is expensive. Its P ratio is 22, or whatever. Now it's like in the 30s, whatever. But the point is you're missing out on why the PE ratio is what it is. It's because this firm literally prints money and it's growing, which is pretty amazing for a company which is as in-depth, has as much penetration as it does. It still grows its revenues and profits. And so those are the things you should consider, not the mechanical thing like, if you're in the top 20% of book to market ratios, you're a value stock, and if you're in the bottom 20%, you're a growth stock. And if you use a very mechanical static approach, you are going to do badly. All those factors you mentioned probably have played a role. The fact that this new millennium has been extremely good for these companies at the vanguard of technology, and it's not been good for the traditional kind of companies. And there have been other factors people have said, like, that in general, there's been a disassociation with fundamentals because of the rise of passive investing and ETFs and so on and so forth. Right. So this all kinds of explanations one can come up with. But I would argue the biggest thing is, if you define value investing, I would call G-Score a value investing strategy, right? Because I am looking for, especially the recent version of my paper, which combines G-Score with a valuation metric, is absolutely value investing because you're looking for value. You're looking for value among growing firms, but it's still looking for value. So
it's been a deep value strategy in the past 10 years with how well it's done. Those firms are all significantly undervalued relative to what they ended up doing.
Right.
By the way, Professor, I love your ability to make these real world analogies. And I think when you can do that in investing, it just can take these concepts and just make them understandable for, the average person that may not be, in it day to day. So those are really great.
So this I think has something to do with my sort of training at Harvard Business School, where so Harvard Business School is not known as a place of great intellectual rigor. My research is quite rigorous, but that's stuff I picked up along the way. But one thing they really drilled into us was you should have the ability to explain whatever you're doing to a lay person in like one paragraph, right? If your stuff is something that you can only explain to other academics, you're not doing anything useful. So I've always tried to, I've tried to make my research quite approachable. So if you look at my papers, you don't really need any great knowledge of econometrics. You can read my papers and get a sense of what I'm doing, even if you're, not the most technically qualified. Obviously, you need to have the basics of, let's say, accounting and finance and economics and all, but you don't need to be like a PhD certainly to understand what I'm talking about. So
I wanted to shift and talk about one of your other papers about financial stocks, because one of the things both practitioners like us and academics like you tend to do with our strategies is we'll create this great strategy and then we'll say, all right, just throw out the financial stocks because they're so different. It just doesn't apply. And you tried to tackle that in this paper. You tried to take a look at some ways to maybe separate winners from losers in financial stocks. So I'm wondering if you could talk about why financials are unique and why they can't be valued with some of these traditional methods, and then what some of the things you came up with that do help to separate winners from losers in that space.
So I'm glad you asked this question. So here too, right? This came from teaching. So I've been teaching this financial statement analysis, now called Business Analysis and Valuation at Toronto, for basically my entire academic career, 20 plus years. So students would come to me and say, for the group project, say, I want to analyze company A, I want to analyze company B. And I would always put out this notice saying, okay, you can analyze any company you want, but no financial services, no utilities and stuff, because they are different. And I would just give this like blanket, they are different thing, which is deeply dissatisfying for both the students and me. Because remember, I taught in New York for 12 years. A large percentage of the students were going to end up working for one of those financial services firms. And they couldn't analyze a Goldman Sachs, or they couldn't analyze a Citibank or whatever, a Bank of America or whatever the case might be. So I said, this is ridiculous. So I said, I'm going to at least start one session, one class, where I'll say, okay, your traditional ratio analysis doesn't work in banks, but what does work? So I actually went back to school. I went back and I read some books and said, okay, what are some ratios people are looking at in the financial services sector? And this is purely from a teaching perspective. So I said, okay, you can't do a traditional ratio analysis because, the whole financial statement is different. Like, I didn't know what a bank's financial statements was till I actually looked at it. And I saw the word revenue appearing halfway through the income statement. I said, what's going on? Like, then I saw like, that, okay, financing is operations. So this operations versus financing is totally different. Nobody talks about debt to equity ratio. It's like, it's capital adequacy. And so I firstly spent a little bit of time trying to understand this stuff myself. I'm no way an expert, but at least have the sort of basic idea in my mind. And I first taught it. So I would teach it, and I would actually have this very interesting case. And this case was about Bank of America acquiring Fleet. If you remember, Bank of America acquired Fleet in like 2006 or something. Yeah. Mm-hmm. And so I then looked at those two companies and looked at the ratios and tried to look at some of the ratios and see why are the ratios different? How does it affect the valuation? So basically, what I tried to do was I tried to give analogs. They're not exactly the same, but what are the analogs to like an asset turnover ratio, a profit margin ratio? So I looked at things like, what's your net interest margin? Then how risky you are. So look at a capital adequacy ratio, look at your loan loss provision ratios and stuff. So I came up with like some 7 or 8 ratios, which try to look at things like, your operational efficiency, your prudence, and your growth prospects. So I try to kind of mirror something similar to what people like Piotrowski does in F-score or what I do in G-score, but using these bank ratios. And then as time went by, I had some colleagues in Toronto, and some of them were actually more interested in financial services. So we had this discussion saying, hey, why don't we try to use this sort of F-score, G-score methodology, but use it using these ratios which are very particular for banks? Because if you look at Piotrowski's paper or my paper, just like you said, we look at the universe of firms, we exclude banks. So they basically be kicking out all those banks. And those banks might be a significant portion of, stock markets. And certainly they have a huge impact on the GDP as the financial crisis should. So what we tried to do in that paper was exactly do the analog, but do it for bank stocks. And so we came up with these, I don't remember the exact number, but we came up with like 7 or 8 ratios. So we looked at things like net interest margin. Obviously, we looked at ROE and ROA because profitability does matter, but we looked at like loan loss provision ratio, earning assets ratios, loans to deposits ratio. So ratios which try to look at which banks are being prudent and which banks are being efficient with the way they use their resources, and which banks are also investing in like growth. And so we try to combine those into a index. I'm very, very innovative in my names. G for growth and B for bank. So it's called B score. So,
Nice.
and we actually found that this B score stuff actually works reasonably well in predicting winners and losers in banks. And what was particularly interesting was, and this is back testing, obviously, right? So I don't know, it should have worked in real time too. It actually worked well during the financial crisis. In terms of, if you look at the year 2008 and 2009, right? Bank stocks got killed, right? The average bank stock earned like negative 70%. But if you had invested in the bank stocks which had high B scores, you would have earned like negative 15% or something. So it would have helped. I mean, it's still a negative return. If you'd done long short, you'd have made lots of money. If you'd done long short within banks, right, invested in the high B score and gone short in the low B score, you'd have made money. But I'm just saying the point is just paying attention to the bank fundamentals the same way as you pay attention to the regular fundamentals would have actually held you in good stead. And the basic point again is the same, it's important to look at fundamentals, but what good fundamentals are depends on the context. So like the Piotrowski F score is great for value firms. My G score might be good for growth firms, and something like a B score or something like that might actually work well in the financial services or banking.
I bet that performance in a way it was a reflection of maybe your metrics were selecting more conservatively run financial institutions, which would have probably held up a little bit better.
Probably. So like if certainly prudence was one of the factors we looked at. So for example, if you had good loan loss provisions in the past, it might have, but remember, all these signals don't necessarily work together. Like, so for example, if you have an extremely good capital adequacy ratio, it will hurt your ROA, right? It will hurt your ROE and stuff because you have less assets which are actually deployed and stuff, right? So you're taking less risk. So it's not clear that these things, all signals don't go together. Some of them are probably negatively correlated. But for the index to do well, you obviously need a good mix of these things where you obviously not, you don't want a bank to be somebody who just, takes some people's money and just keeps everything out of fear that somebody's not going to pay. On the other hand, you don't want a bank which is like just taking an incredible amount of risk and making risky lending decisions to earn a very high spread. So you want something which has a combination of an appropriate level of risk taking. And that's probably what our B score paper actually picked up. Now, obviously, I haven't gone and back tested it and further and see how it's done in these few years since the market has recovered. But hey, maybe that's the next thing for you guys to do in Validea. So.
Yeah, we can look at that for sure. Jack and I wanted to kind of switch gears for a second here and talk about another piece of research that you wrote. Jack and I are both active on Twitter. We don't have very large followings. I think I might have like 1,300 followers. Jack is maybe cracking the 2,000. So we're working on our building our number of followers. But you wrote a paper that looked at whether Twitter and the aggregate opinion of investors on Twitter had any predictability with future earnings and stock returns. So I thought that was very interesting. Could you maybe give an overview of what you found?
Absolutely. So by the way, people have looked at Twitter and the like academics and others have looked at Twitter in one of two ways. Many academics, especially in accounting, have looked at Twitter as a disclosure mechanism. That is, how firms are using Twitter to disseminate their own financials and seeing if that helps them, their stock prices being more efficient because they're getting the information out to investors faster. They're being more timely with their disclosures, with their press releases and so on and so forth. So that was people looking at it from an investor relations perspective. People in finance are looking at Twitter in an aggregate perspective, saying that, if the aggregate sentiment of everybody on Twitter about the economy or whatever is positive or negative, what implications does it have for, let's say, how well the S&P does next month or something like that? Our paper was different because we were looking at Twitter at the firm level. So let's just say you have a whole bunch of people tweeting about dollar symbol AAPL, okay? And so we aggregate the tweets. So there were a couple of things we did. Firstly, we had to, I guess if we had planned it in advance, we could have been creating the data set ourselves, but we decided to do the project and we had to buy a huge like core dump of tweets from Twitter, actually from this company called GNIP, which now has been acquired by Twitter, which is a data aggregator. So we bought these tweets, and then we looked at, these are tweets by individual people. So this could be tweets by people like you, or it could be just some random person saying, hey, I think dollar symbol AAPL is going to pop, or something, but it needs to have that dollar, the cash tag of that ticker. And we looked at the period, let's say that 10 days before earnings announcement. So from like 12 days before to like 3 days before. So there's no spillover into the actual announcement. And we looked at each tweet, and there were 2 or 3 different ways of doing it, but we parsed each tweet either by using some sort of algorithm which reads the tweet as a whole, or by doing some sort of word count of how many positive and how many negative words are there in each tweet. So we then give each tweet by each tweeter a certain value, and then we aggregate all the tweets for, tweeted by anybody about that given stock. And we use some sort of common sense adjustment. So for example, if Justin has 2,000 followers and Jack has 5,000 followers and I have 10 followers and each of us tweet about Apple, I'll give more importance to your tweets than my tweets based on the number of followers you have and stuff. Obviously, if Jack Kramer says something and he has like a million followers, we'll give that more importance and stuff. So we kind of try to come up with this notion of wisdom of crowds. So this whole thing is based on this idea called wisdom of crowds. And it's actually a very fascinating story. So in the 19th century, there was this British social scientist, I think his name was Thomas Galton. He carried out these experiments in like country fairs where you have this massive cow and you ask this random crowd of people, what do you think the weight of the cow is? And one person will say, I think it's 300 pounds. And one person will say it's 2,000 pounds. And one person will say it's 5,000 pounds. And he got all those responses. And then he would have some experts, people who are actually, working in the dairy industry, and have them make the guess. What he found was that the average, firstly, the people were all over the map. Some people are going to be it's like the price is right. One person is going to guess like $20 and the other person is going to get $5,000. But you take the average of what these people say. I don't remember if it was mean or median, probably the median, right, of what these people say. That was often closer to the truth than what the expert said. So this is what people refer to as wisdom of crowds. Mm-hmm. So what we said is, does this wisdom of crowds apply to something like Twitter? Because Twitter is incredibly powerful. And, as you can see, it can be incredibly destructive as well with fake news, and it can influence things like elections and so on and so forth. But it's an incredibly powerful new source of information. And so we said, can we do this wisdom of crowds in the case of firms? So we aggregate all these tweets and come up with some sort of an aggregate opinion variable. And we ask ourselves, does this aggregate opinion variable predict future earnings surprise and the stock market's reaction to the earnings surprise? And what we found was it actually does. So for example, if the aggregate sentiment on Twitter for a stock is positive, that firm is likely to have a positive earnings surprise. So there's something in Twitter, the collective wisdom of everybody, over and above what's already out there. So we control for what's in the financial statements. We control for what's already out there in the business press. So we control for sentiment in traditional media and so on and so forth. And controlling for all that, the sentiment on Twitter predicts future surprises. And it doesn't predict just the future surprise, it also predicts the market's reaction. So not only is information relevant, it's incrementally relevant. So this information hasn't reached the market through other sources. And then we find that Twitter has 2 roles. One is it can be new information. So for example, some dude out there can tweet, hey, I think dollar symbol AAPL is not doing well because this new iPhone 12, the lines at the Apple store weren't as long as they used to be. It could be something quite atomic, like some random tidbit like that, right? And if you aggregate all that together, it seems to add some value. So that's what we found. Twitter has 2 roles. Number one, this kind of stuff, people actually providing new information. And this is like a new source of information. It's a democratic source of information. The traditional sources of information, like, analysts and firms and stuff, they have things like conflict of interest and all these things which affect the independence of that information. But this information can be incredibly noisy and can be incredibly wrong. But you're hoping that with a large number, the wisdom of crowds will throw out the extremely wrong opinions on both sides and you're getting the aggregate stuff. And the second thing Twitter does is it's also a means of dissemination. So we found that both original tweets as well as disseminating tweets, where the person is not tweeting something original, but linking to, hey, look at this cool report on Apple from Fidelity or something like that. We found that those kind of tweets also helped predict exactly what's going on, right? So both the information aspect as well as the disclosure aspect. Now, actually, I have a follow paper to that which I'm working on right now, just trying to see if this has a similar impact on debt markets. And the logic here is what we found in the first paper was the information on Twitter actually works better when the information is negative. That is, negative information has more credibility than positive information. And given that this information is more important when it's negative, a natural reaction to our question to ask was, should this matter for fixed income markets, which seem to focus much more on negative news, right? So for example, you have things like bankruptcy risk and so on and so forth, and the likelihood of being downgraded and so on and so forth. So what we actually find was this information on Twitter actually predicts changes in things like your Altman Z-score and so on and so forth in future quarters. And so in a sense, it can predict expected risk and changes in riskiness. It works better for speculative bonds as opposed to, let's say, high-grade bonds, again, because those are much more sensitive to bad news. And so that's what we're working on right now. So I think that's the reason why many institutional investors are actually paying good money to get real-time feeds with Twitter sentiment being provided by different data providers. So.
That'll be
that's really
interesting.
Sorry. I was probably skeptical about joining Twitter when I first did, but I've found like the quality of information on Twitter is incredible, and the talented, smart people, especially in the finance space that are there, I've been blown away by that.
Yeah, and actually before this Twitter, there was a paper by a couple of people in finance who looked at reports on Seeking Alpha, right? And Seeking Alpha, again, this is completely crowdsourced, right? Or there's a data source called Estimize, I'm sure you've heard of, right?
Yep,
Where
yes.
people have actually shown that the analyst forecasts on Estimize are much more accurate than the actual analyst forecast.
Mm-hmm. Yep.
Interesting.
So it's kind of picking up the same thing that, these are people. So you can argue that how can I trust this? It's free and some person is putting it up. The fact is there are lots of people putting it up. There is strength in numbers, and on average, the stuff actually works pretty well. So
I've also seen some research or data that shows like this natural length, like aggregation of, sort of news and sentiment. It can, to your point about risk or identifying like a negative screen, if you will, like it does a good job of that, or maybe a better job of that in terms of identifying companies that, are likely to have problems.
Okay. If you can, actually, I'd love to see that. If you can provide me a link,
Okay, yeah. I'll send you something on that. Yeah, for sure.
Yeah, that would be great. Yeah.
For the last question, I wanted to shift to the practical application of the work you've done. One of the things I noticed when you talked to Toby Carlisle is you talked about how, because of the time constraints you have, your investments primarily are passive investments. You're primarily investing in indexes. But I was wondering if you took that constraint away, given all the things you've looked at value, you've looked at quality, you've looked at growth. I'm wondering if you took that constraint away and you had to invest for the next 30 years, would you continue to index, or do you think, some of these things are worth investing in terms of generating excess returns over the market? And if so, is there an area you might focus on, growth, value, quality, something like that?
So, that's a great question. Now, obviously, I think the stuff that what you guys do is incredibly valuable in the sense that you guys are you take the, what could remain ivory tower. I mean, I try to make sure that my research is not ivory tower, it's accessible, but the fact is it's accessible only if people choose to access it. So people like you who take academic research and actually apply it and obviously modify it in whatever way you see fit, but apply it in a way that's approachable to the actual investor is extremely useful. So I hope that will continue to be the case. And I know for a fact that the reason why all these hedge funds and all these guys often hire PhDs in accounting and finance is because they're looking for people to actually bring some of those insights and apply them. So I think there's some value to that. So I'm not sure I'm going to continue doing this. Part of it is simply because I've been so busy and I just haven't. Think about if you're a if you're a day-to-day stock investor, you really need to have time to spend on it every day, right? You need to monitor your portfolio every day. You need to have like, stop loss functions and, entry points and exit points and all that stuff. And I just didn't have the time or the inclination to do that. And, my investments were doing okay. And I said, I'm not somebody who's infected with this FOMO business everybody seems to be, which is like, man, I wish I'd gotten to Tesla at 500, or I knew this thing was coming. I wish I'd bought Zoom stock and stuff. I mean, these are all things which don't bother me, because I've had a few good, like I did buy a handful of Apple stock in the year 2000. Like, I was lucky enough, like, not much, a few $1,000s, but that's probably, increased 100-fold or whatever it is since then, right? So you have to, count your blessings and move on. So, but getting back to your actual question, right? Fundamentally, I'm a big believer in long-run market efficiency, but I'm not a doctrinaire believer in market efficiency. Right? If markets were completely efficient and perfectly efficient, I mean, I wouldn't have my research and you guys wouldn't be doing the business. You guys wouldn't be in the business you're in. So you require a certain amount of market inefficiency. But what you also need to know is you need to understand why the markets are being inefficient and trying to identify the channel through which markets are being inefficient. And I think one of the reasons why markets are inefficient, and I firmly believe this, is when I say markets, it's an aggregation of individuals, right? So the people who make the markets are often mechanical about doing things. And they're mechanical about doing things like, for example, identifying what's a value stock, what's a growth stock. Or I'll give you a simple example, right? People, when they do mergers and acquisitions, they do this thing called accretion and dilution. Okay? This is something which really angers me, because I think this is just so wrong, right? It's like they take such a mechanical view that if you buy a company with a lower P ratio, this is an accretive transaction, simply because magically that firm's earnings will get your P ratio and everybody's happy. Like, without trying to understand that the lower P ratio might have something to do with the, the fact that the firm had a lower growth prospect or was less risky or whatever the case might be. So I think when people are extremely, and this is, by the way, is one of the reasons why on average, most M&As don't perform well, because people are doing things extremely mechanically. So as long as there's some subset of the population which does things mechanically, you will find that doing things in a slightly more analytical fashion, understanding the accounting, understanding the finance, understanding the economics, will always give you the edge in trying to find that elusive alpha everybody's out for. So again, who knows what the flavor of the next 15 years will be. So for example, when I wrote the G-score paper, I always envisioned this was going to be a long shot idea. In fact, if you look at my paper, I end the paper by saying that this paper is probably more applicable on the short side, because I've already identified firms which are extremely highly valued. So the upside is likely to be smaller. The downside is likely to be higher. The reality is turned out to be exactly 180 degrees the other way, right? So it's very difficult to predict how these things are going. But having said that, if you just apply common sense strategy, like, don't overpay for something unless you know why you're paying for it, okay? Know why a firm is valued the way it is, and understand the basics of what makes a firm succeed or fail. So for example, it's quite possible that while we might like discuss about how crazy it is, Tesla might yet be undervalued. Who knows? Because you really need to understand, you need to have a crystal ball about the future of like the electrification and EVs and what the conventional ICE engine auto companies are going to do and so on and so forth. So it's going to require lots of in-depth analysis, but my overall, this is probably not a very satisfactory answer, but just understand what you're buying. Don't buy something because the guy next door is buying it, or because the ratio looks good, or it's, the ratio looks good, or whatever it could be, because, the firm is, not worth what it's, a low PE firm might be a low PE firm because it deserves to be a low PE firm. On the other hand, high PE firm might actually still be undervalued because it's got very good prospects. So try to tie in these three things together, and I think in the long run, you can't do too badly.
Professor Mohanram, I think that's a great way to sort of, I think, bookend the conversation today. You shared a lot of wisdom. This has been enlightening and educational for me. If investors, I know you're sort of a little bit under the radar, but if, people want to learn more about you and your research and what you're doing, where can they go to find out more or learn more about you?
Okay, so firstly, most of our papers are in the public domain. So many of my papers are available on my own website. So if you just Google my name, Partha Mohanram at the University of Toronto Rotman School of Management, you should be able to find my website, and many of the papers would be there. You can also obtain many of the papers through searches on places like Google Scholar and ssrn.com. Many of these, the SSRN may not have the published version of the paper. It might have a slightly earlier version of the paper because of copyright reasons, but the insights are all going to be there. So if you look at ssrn.com, my most downloaded version, my paper is my G-score paper, but it's actually a working paper version of the paper, but that's fine. It's basically the same insights. So you can certainly get many of our, and this is not just for me. If you want insights from any academic, right? Most of the stuff is going to be on their websites. It's going to be on Google Scholar. It's going to be on ssrn.com. So that's great. 3 places you can go to.
Yeah, and we'll put links to all the stuff that we referenced in the show notes as well. So thank you very much for joining us. Hopefully we get to do this again sometime. And
anytime.
It's not another 15 years from the next time we see you. But we certainly enjoyed it. So thank you very much.
Thank you.
Absolutely. And once things improve, and if you guys come up all the way up here to Canada, I'd love to, host you guys at my office or something, and we can have a chat.
That's great. Thank you.
Terrific.
All right. Take care. Bye.
Thank you very much.
Thanks.
Hi guys, this is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJ Carbonneau. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.